Welcome to Mortgage 101, where you will learn the important steps of buying or refinancing a home. Hello, I am glad you are here. My name is Nathan Rufty, a mortgage loan originator with over 25 years of lending experience that has your best interests in mind. After listening to this full podcast, connect with me to discuss your home loan needs. Now on with the show. Hello and welcome to another very informative podcast with Mortgage 101. Hello, my name is Nathan Rufty, a loan originator in California and Arizona. Today's topic is going to talk about why did my mortgage payment increase? There are several factors why your fixed rate mortgage increase that you may not be aware of or thought of might increase or possibly decrease your mortgage payment. Once you sign your final loan paperwork, and you need to talk to your loan originator at the very beginning that you're going to go on a fixed rate. Adjustables in today's market is not the prevalent interest rate that's going right now. They are fixed rate terms, whether it be 15, 10, 20, 25 year or 30-year fixed rate mortgage, whether that be on a conventional FHA, VA, or USDA. It's fixed rate, 30-year typically, but they're fixed terms with fixed interest rates. And you can tell on your note when you sign the final paperwork, but going through the whole entire process, you're going to see that it's a fixed rate. And the note at the very end when you sign your loan paperwork, if something happened between your loan estimate, which you get disclosed on, and the CD, which is the closing disclosure, you're going to sign that 3 days prior for signing your final paperwork. It's going to say fixed rate on there. But an adjustable rate note is going to say adjustable rate note right at the first page of the note. If it's a fixed rate, it says note, and on the deed of trust, there's going to be an adjustable rate rider. But you go in on a fixed rate, interest rate, you're going to come out on a fixed interest rate. Your loan officer will stay that all the way through, so not to worry there. But do check the paperwork. Once you get the loan disclosures, the loan estimate, the closing disclosure, and the final paperwork, look at the deed of trust to make sure there's no adjustable rate rider. And on the note, it's going to say adjustable rate note, and also you're going to have an adjustable rate rider, so you're going to sign some additional paperwork when it's an adjustable. But why does your mortgage payment increase or decrease? Two things, or possibly three, depending on where you live. But the two major ones is your homeowner's insurance and your property taxes. Your homeowner's insurance goes up and it goes down. And we all know things don't generally go down. But your homeowner's insurance will go up if you have an impound account. So these are loans that where you're paying your property taxes and your homeowner's insurance within your mortgage payment. So you're going to see your principal and interest payment's $1,000, but your total overall mortgage payment's $1,500. Well, $500 of that's going to go into an escrow impound account, and every single month you're going to see an escrow balance increase. And then depending on where you're at, you're going to see every 6 months and once a year, you're going to see a chunk come out of that escrow balance to pay your property taxes annually or twice a year and your homeowner's insurance annually. So there's going to be 3 disbursements from that escrow balance account every year. 2 times for property taxes, 1 time for homeowner's insurance. So you're going to see that go up and go down. Us in the mortgage industry, we have to maintain 2 months of reserves of your property taxes and your homeowner's insurance. So let's say your homeowner's insurance is $50 a month on average. So we're going to disperse $600 a year for your homeowner's insurance. Well, after we do that, we need to have $100 of reserves in your escrow balance to account for any adjustments on your homeowner's insurance. Let's say you pay $200 a month for property taxes. I know in some areas that's low, but $200 a month on average, that's $2,400 a year for property taxes. Well, we got to have $400 in reserves once we disperse it every 6 months. So we must maintain a reserve account as well within that escrow account. Hopefully I didn't lose you there, but we got to maintain 2 months. So 2 months of reserves for the homeowner's insurance, which it's on a 12-month basis on average. So we basically got to have 14 months of mortgage insurance, homeowner's insurance inside that escrow account. 14 months of homeowner's insurance. And then we got to have 8 months, maintain 8 months worth of taxes in there. You pay up to 6 months. Once we disperse and pay your property taxes, there should be 2 months reserves, and you build it up as you make those mortgage payments. So we must have 2 months reserves. Well, if you file a claim on your homeowner's insurance, or you deem to be in a wind area or a fire area, your homeowner's insurance is going to go up. That's just the beauty of owning a home, and it's the beauty of living in where you live. You're going to pay for it through homeowner's insurance, especially in California with the fires and the floods and the earthquakes. Things are going to increase because of the damages. So your homeowner's insurance, you're going to see increase, as well as your property taxes. Every year or every 2 years, the county's going to assess your property, and let's say they assessed it for $300,000 1 year. Then 2 years later, they assess it for $325,000. As property values increase, your property taxes are going to increase. That's the beauty of being a home ownership. It's a double-edged sword. You're gaining equity, but also the cost of owning that home is going to go up through property taxes. So the lender says, okay, we're going to disperse the money based on the property taxes from assessed value from 2 years ago. And next thing you know, they get the bill, they pay it and go, whoa, we don't have enough in reserves. We got to increase your monthly mortgage payment, or you got to come in with a big lump sum to cover that shortage and increase your mortgage payment. So that's why your mortgage payment is going to increase if you have an escrow account, which means you pay your property taxes and your homeowner's insurance within your mortgage payment. Some people below 90% loan to value on a conventional elect not to impound their account. They'll pay their own account every 6 months on the property taxes and annually on the homeowner's insurance. With Govy loans, USDA, VA, and FHA, you're required to have an escrow account, whether you like it or not. You're going to take it. Anything on a conventional at 90% loan to value or above, you're required to have an impound account, an escrow account. So if you're an 80% loan to value and you elect not to have an escrow account on a conventional, you don't have to have that. But that's why your mortgage payments increases and sometimes decrease. Decrease means there's too much money in there. The property values have plummeted and there's too much in your escrow account. So the lender will cut you a check and say, okay, here, and they may decrease your mortgage payment as well to adjust because of the property taxes have decreased. They're collecting too much money. They're going to lower your monthly mortgage payment and give you a refund back in your escrow account. That's going to be a recession. That's going to be what happened back in 2008, 9, 10, and 11. If you held onto your property that long, is your value went down. So they readjusted your monthly mortgage payment and gave you back an escrow refund check, but at least maintained enough in there to cover going forward. So your mortgage payment, your principal and interest payment, and if you have mortgage insurance did not adjust. If you sign for a fixed rate, you're going to have a fixed rate. It doesn't arbitrarily go to an adjustable interest rate unless you signed an adjustable rate that was only fixed for 5, 7, or 10 years fixed, and it's going to go adjustable after that. But like I said, in today's market, that's not a highly prevalent loan right now. It's fixed rates, 10, 15, 20, 25, or 30-year fixed rates. That's what's dominating right now in the market. The rates are extremely low. Lock yourself into a long-term fixed interest rate that's not going to move. But your principal and interest payment, if you have monthly mortgage insurance, will remain the same. Your monthly mortgage insurance will not go up. Your principal and interest payment will not go up. What does adjust is your overall payment will adjust to account for the shortage of your escrow account, which is your homeowner's insurance and your property taxes. So that's where you see that adjustment is because of those two items. Your mortgage payment, PI payment, principal and interest payment did not adjust. You're not on a fixed rate, an adjustable rate unless you sign for one. But if you're on a fixed interest rate, note rate, your principal and interest will remain the same throughout the term of that loan, however long you sign for on a fixed rate. But those are the two common numbers on why that mortgage payment will increase. Sometimes will decrease, but mostly it's going to increase because the assessed value is going to increase. And being in California, a lot of people's homeowners insurance has increased because it's either a fire area or a wind area that has increased their monthly mortgage or homeowners insurance policy. Their annual policy has increased, which adjusts their monthly payment, which there's not enough in your escrow account. So when you're looking to purchase a home, do account for those small adjustments. Sometimes they're large adjustments going upward, but do account for those. That's why that mortgage payment is going to increase, is because of those two factors. There's a shortage in your escrow account. So at the very, very beginning, especially in California, you have those supplemental taxes, you have Melrose taxes. Make sure your lender adjusts this correctly from the very beginning. Lenders should go in there and look at the tax rate of the house, because if the assessed value on that home is $300,000 and you're buying it for $400,000, well, the new assessed value is $400,000. So if the property tax is 1.25 on that property, well, that property's taxes is 1.25 of $300,000, because that's what the county assessed that homeowner over the years. Well, if you're buying it for $400,000, the new assessed value is $400,000, so it's 1.25% of the $400,000. So we're going to base it on that. We're going to adjust for that. Now, going forward, there may not be enough money in that escrow account, because their $400,000 may get reassessed a couple years later at $425,000. So the county is going to get you, hit you for that extra money that you've increased in assessed value. They're going to want more money out of you for property taxes. So that's what, and if you got an escrow account, your lender's going to go, there's not enough money in this escrow account. We got to up your monthly mortgage payment, which is because your property taxes have increased. So they're going to adjust for that, but your principal and interest payment will remain the same. Over time, it's going to stay the same. But over time, you're going to see that principal and interest payment. Some of it goes to principal, some of it goes to interest. Over time, you're going to see more of it go towards interest, because it's front-loaded with the interest. You're going to pay most of the interest up front on that loan. Depending on what term you have, you're going to start seeing more of it going to principal. But the reason that property, your payment goes up, is because of the property taxes. Do know you're on a fixed rate if you sign for one, and your loan officer should be right up front with you, which 99% of them will tell you right up front, this is a fixed rate. There should be 100%. Very, very transparent industry now. You get a lot of paperwork to be transparent in our business, that you're going to see on all that paperwork that you're on a fixed rate, unless you're taking adjustable and you know that you're on an adjustable, and there's more additional paperwork that you're going to have to sign acknowledging that you're on an adjustable rate mortgage. But those are the factors on why your monthly mortgage payment has adjusted, is the property taxes and the homeowner's insurance. I know that was a lot of information. Hopefully it clarified that up with you. But if you're looking to purchase a home, do account for those adjustments going forward. And if you're looking online and you see the property taxes are based on X, those are not 100% accurate, because they're not going off the future value. They don't know what the home is going to be going into escrow for and what's going to close for. So right when you get into escrow, make sure your loan officers, what they should do, which they probably do anyways, is make sure it's getting the proper tax rate based on that purchase amount adjustment going forward. If not, you're going to have a huge shortage in your escrow account, and that payment is going to go through the roof. That 12 to 24 months later, after home ownership, that payment's going to go up if they did not calculate that property tax right. All right. Thank you very much for taking the time out for listening to this informative podcast about why your mortgage payment increases. Nathan Rufty with Canopy Mortgage. Give me a call if you got any questions on refinancing your property or possibly purchasing one in the state of Arizona and California. Thank you very much. Bye. Thank you again for taking the time to listen to this very informative podcast. Remember to subscribe, share, like, and comment. There is no better time than today to explore your options to purchase or refinance a home. Please call, text, or email me at the information below to get started right away, and I look forward in hearing from you.